Well, hello, Danny Shea. How are you?
Doing great. How you doing, Randy?
I'm doing really, really well. Let me take the time to introduce you to a lot of my viewers. I've been working with Danny for many, many, many years. He's my go-to when it comes to lending, best lender in the industry that I know. You know, when I start working with buyers, every once in a while, a buyer will have their favorite lender that they're committed to using. But if not, I like to get my clients to Danny, and I'll tell you why. I think you're going to find when you're shopping lenders, Danny, you probably agree, everybody runs in very close packs when it comes to rates, right?
Correct.
It's for me, it's a matter of service level, performance, closing on time, communication with a client. And when I say Danny is the best lender I know, and that's why he works with my buyer clients, this is the level of service that you deliver. So for that, I'm very grateful, and that's why actually I invited you on this call. Got some questions. Can we just jump in?
Sure, absolutely.
So speaking of rates, when lenders start quoting rates, I think the public is maybe a little naive as to the fact that there's different terraces based on based on purchase price or loan amount, right?
Exactly.
Can you really briefly run us through what those terraces are and why maybe some of the rates fluctuate?
Sure. The majority of the programs that we see, now you've got your government loans, which are your VA and FHA, but the majority of the loans out there are going conventional, and they kind of break into three different tiers, right? So your basic conventional loan goes up to $510,400.
Okay.
And then in some areas, they call them high-priced areas. So Orange County, Los Angeles, San Diego, and other similar communities out there have different amounts that they'll allow you to go to a higher loan amount. So for example, Orange County is at $765,600 currently. That changes every January, but that's currently where it's at. And those are known pretty much as Fannie and Freddie loans in the high balance space. Anything over than that gets into your jumbo investors. That's where lenders are kind of keeping the loan on their own books. And those go, $15 million, but it's primarily anything over $765,000 right now.
So when you say 765 and those other price terraces, that's loan amount. That's not purchase price, correct?
Correct. Yeah. So depending on what the client is putting down, that would be what the loan amount could go up to be considered that program.
Okay. So if we look back historically, this year started off really low, like January and February, rates were very, very low. I call that BC, before Corona. So, we're talking, it's April 16th, it's Thursday, very different from what it was in February and possibly very different from what it's going to be in June. When you kind of characterize BC, before Corona, January and February, in the rate environment, and then we got up into a period of time where you and I were talking frequently because we had some buyers that were priced out of the market based on kind of what was going on with loans. And you cautioned everybody, you said, just stay calm, it's going to bounce back. But we went from really low to crazy to now things have settled out. Can you explain kind of, for most loans, where they were, where they traveled to, why, and how come we're at this settling point right now?
Sure. We've seen, like you said, we've seen rates all over the board. In the beginning, January, February, BC, before coronavirus, for the three different programs, regular conventional conforming was about 3.375. High balance was exactly the same, and jumbo was about 3.5. Now, of course, everyone's rate's going to be a little bit different depending on credit score, primary residence, how much they're putting down, and what day they're locking it in. And then what we saw was, as coronavirus started to hit, rates actually got better. So rates first dropped, and they didn't drop a lot, but they dropped and got even better from where they were in January and February. And we watched rates drop about an eighth, right? So conventional conforming was at 3.25. High balance was right there with it. Again, they were exactly the same. And jumbo was about 3.5, so still the same. And then what happened was, kind of at the peak of this mess, rates started to jump. Investors started to get worried about, our clients going to be making payments and how that's going to affect servicers. And so rates were all over the board on different days. Conventional conforming jumped up, not a lot, to 3.75. High balance jumped to about 4.5. And this is all April 1st. And then jumbo was still about 3.875. Today we see.
So what was the reason for the spike? Were lenders nervous?
Well, what happened was Governor of California came out and told clients essentially to call their lender and ask for a 90-day forbearance. And what happens in our world is you have to understand there's a servicer that you make your payment to, and there's the actual investor. So Fannie, Freddie, a lot of times in the back end. Those servicers are still paying Fannie and Freddie. So Randy, if you're not making your mortgage payment, as well as millions of others, those servicers are still making that payment to the investors. And there was a liquidity issue. They did not have the money, in theory, to continue to pay their investor if they're not receiving payments in. Okay. So they all kind of got worried about, will they have enough money to pay out their investors? And they moved up rates to try and slow down new issues coming in.
So where
today
do we
that's settled.
Where do we sit today?
Yeah, so today things are starting to come down, and we're not out of it yet. But today, conventional conforming is down to about 3.25, so back to its lows during this time. High balance is still a little bit higher, but much better than it was at 3.25 today. And jumbo is all over the board, Randy. So there's so many different jumbo investors out there. There's some in the low threes. There's some that are still up in the fours, but they're all over the place.
So with the different types of borrowers, you mentioned about credit scores and different types of borrowers in this environment. Are there any borrowers that are more affected than another trying to get a home loan? Let's assume that they're in the somewhat conventional range. They're not high value, but they're the every buyer, if you will.
Yeah.
Is there any segment of the buyer population that's having difficulty right now?
Yes. So anything that has any type of adjusters. So for example, lenders look at what's called risk-based pricing. So they look at you and say, okay, Randy, what's your credit score? How much are you putting down? What kind of risk are we taking on by lending out money? Those loans that have a little bit of risk to them, maybe they're investment property, maybe they're a small amount down, maybe there's a credit score issue or an income issue. Those adjusters in the market are a lot larger than we used to see. So we really see rates spike up for those people that maybe have missed a payment or two in the past, or are not the A+ perfect borrower right now.
So would you say, how does it affect like self-employed and W-2 people and that segment?
Got it. Well, let's remember, last week, 5.2 million people put in for unemployment, which gets us in the last 4 weeks to about 22 million Americans. So everyone's worried, did their clients just lose their job, and do they still have the ability to repay? That puts unemployment around 18% of the population.
Yeah.
Which is pretty scary. So every lender is worried about, the loans and the portfolios they have. And really, that doesn't even take into consideration the people that maybe just hours got cut, or just aren't working the same schedules. Their bonuses aren't going to be what they were before, especially if you're self-employed, right? So let's say you're self-employed and you've been making the same income for the last 10 years. It's a new world, and we're not sure how that's going to shake out, how people are going to be affected. We feel everybody's affected in some way, but how do you base risk on that? So there's so much uncertainty. It's making it really hard for investors to make decisions based on the way they used to do business.
So it sounds like this is where your counsel really comes in with the borrower in terms of strategizing how to go about making a home purchase, along with my input. But the finance is really in your area. What I'm curious about is, it's obvious. I'm working from home today. I hardly ever have done this before. Looks like you're working from home today. We are definitely making adjustments in how we do business. What other kinds of changes are you seeing on your side of the fence? Because you do the loan part of this transaction. I work with the client on the selection of the purchase, making the offer, going through the escrow process. You're so deep dive on the lending part. What do you see in your world that is different today than BC?
I mean, the biggest thing is we don't really get to meet our clients anymore, right? So much more is done via email, via text. It's a virtual world, even more so than it was before. And the big thing is people are scared. People worry about other people coming to their house. So things like appraisers, inspectors, notaries, it's all a different world. Everyone's trying to adapt. For example, let's talk about appraisals. Right now we're trying to do a lot more PIWs, which are property inspection waivers. So basically they look and say, have we appraised this home before? Do we have data, a lot of data on the community? Can we make a reasonable assessment of what this house is worth without sending somebody in?
Yeah, I'm hearing a lot from my seller clients that the appraiser drove by the property. They knew they were outside, they were taking pictures. So
Yeah.
there's these, correct me if I'm wrong, but there's these desktop appraisals where they never leave the office. They're drive-bys, and you're seeing more of that today than ever before.
Absolutely. Especially if the person's buying it as a primary residence, we're really trying to do some type of alternative appraisal. Now,
do you think appraisers are more scrutinizing today than before? I mean, are appraisals tougher to get through?
I mean, there's less appraisers out there right now, right? Okay. They're busy because rates are low. But at the same time, we're starting to see, because they're doing a lot more drive-bys, they're doing a lot more property inspection waivers, they're starting to free up their time a little bit and be a little bit more available than they were when things were really tight.
Okay. When you see us moving through this market, kind of fast forward, because I know a lot of people are calling me saying, what do you think prices are going to be like? What's the market? People are connecting with me all the time. And the misconception out there, they start this conversation by, you must be dead. You must not be doing anything right now. Where the opposite is very true for me, and I kind of want to toss it to you. What do you see in terms of like now business, and then what are you seeing moving into the more normal, and what are the changes? What kind of subtleties do you see going forward? How are things going to change, and what's your activity like right now? Because when I'm getting calls like that, it's like, where did you ever get that idea?
Yeah, I get that. I think maybe some people, they're at home working. Maybe their job isn't, it's a little bit different than you and I, but we're busier than ever trying to get the same number of deals through. They just take so much more work re-verifying stuff over and over. So we'll see where it goes from there. But a lot of our clients are worried. They're worried. They went through the last recession, and they want to know, is this going to happen again? People are
So cautious. Does recession mean houses drop in value?
If you look historically, for the most part, no. I mean, there has been some recessions led by housing, the last one, right, which is on everybody's mind. Randy, do you know that during the last recession, the last housing boom, that household debt was at 134% compared to GDP, and people were saving 3.6% of their earned income? Today, or at the end of last year, so call it January 2020, we're at an all-time low, 96% household debt compared to GDP, and we're saving about 8%, which I know sounds still kind of low, but historically is a lot better. So my personal belief is, based on where we were when this started, we're a better point to make it through than we were in 2008.
So people are smarter with their money today than they were before?
The lending isn't like what it used to be, right? Before, if you could fog a mirror, they said you could get a loan. Today, we're still doing so much more to make sure that you can afford that payment, whether it's reserves, loan to value, that we're in a much better spot. And people only remember the last recession. They don't remember all the other recessions where housing actually did pretty well.
So you're admitting that you're busy, you're doing similar number of transactions, and it's just taking a lot more legwork to get certain things done. So you're busy.
We're definitely busy. The transactions are still up. We definitely see some slowing as people are cautious.
Yeah.
Um,
Well, it was interesting. I
but
was talking to my escrow officer, and you know Karen.
yeah,
Um,
of course.
Karen was telling me, because I asked her early on, like about 3 or 4 weeks ago, when all of this was like high nervous time. You know, it was like that curveball thrown at us. So a deal put together today. Everybody's aware of COVID-19 and the coronavirus. But when we were transitioning from February, nobody had a clue into March. I asked her, I said, are you losing many transactions? Because she sees, like you, she sees a wider funnel than I do. And you see a wider funnel because you work with a lot of agents. She works with a lot of agents. I work with a lot of clients. But that funnel gets up to you, and you seeing, you know, more of a general spread of the market. I was asking her, are deals falling out of escrow? And she was telling me, surprisingly, no, most of them are really sticking. Are you experiencing the same thing? And are you experiencing jitters today?
I've really only had two fall out of escrow because of COVID. One because they were scared. One because of a job loss. And Ray, I get a lot of phone calls from agents that are surprised they put something on the market and how quick it's sold in this environment. And it's the same conversation over and over. They're shocked,
Yeah.
pleasantly surprised. I mean, what are you seeing with your transactions? You do a decent amount of deals.
So if I look at the overall marketplace, the first 2 months were holding really strong, actually a little bit ahead of last year. If we look at year to date, we're at April 16th. If I look with 3.5 months of sales and where we are, we're down about 25%.
Okay.
So overall transactions are down, and I think it's a little bit to be expected. What I'm seeing is fewer people jumping in right now, but markedly different from the people that were in process. Those people finished their transactions, and the homes that were on the market stayed on the market. And we've been very fortunate, very blessed. Our listings are selling rather quickly. I only have one that's kind of maybe stuck in the mud. But I think it's a price point. It's a little higher price point. And what we know is that the higher the price, the more difficult the market is right now. But as you come down into the more popular price listings, inventory isn't out of whack. The buyer interest is there, maybe not as strong as before. So I was talking to friends of mine, and they're in all different little segments of the market. And the market was actually pretty good. I've got some friends of mine that were in marketplaces where if they put a home on the market, they'd get 15 offers in January, 15 offers in February. So now they're not getting 15, they're only getting 6. And homes aren't taking, 7 to 10 days to sell. They're now taking 2 to 3 weeks to sell or something like that. So what I'm seeing is the market is relatively very, very strong. The homes that are on the market, and I'm kind of giving permission out there to people that are thinking, should I get my home on the market now? We're definitely doing business very different from ever before. Showings of properties, how I have to arrange with my sellers to get people to see their homes. They've got to be comfortable with having people in their home. The sellers, have to leave their residence while the other agent opens the house. We're leaving doors open inside, interior lights all on, so the buyer never has to touch anything. Gloves, mask, booties, distance, all those are safeguards. We're absolutely paying attention to how we get things done. And the bottom line is business is still there for people who want to buy and want to sell. And we're here in the service industry just like you. If somebody needs to get a home sold, I have a client, they are building a custom home out of state. They've already paid for the lot, paid for the construction. So money isn't so much the issue. They don't need the money out of this house to finish, but they'd like it. And they chose to not wait. Why wait till June, July, or August when we can get their home on the market? It's a recent listing of mine. So the other thing that's changing is the virtual exposure that many agents are now starting to adopt. Historically, my group, we've always done like an over-the-top exposure of property, virtual, magazine quality photography, aerial photography, drones, if you will, video presentation, virtual tours. There's a lot of different technologies out there so that the buyers can see everything about the house. I actually had a recent sale. You'll get a kick out of this. I had a recent sale where an agent called me, can I show your property? And my clients didn't want anybody in the home. The protocol was looking through the windows. So my seller said, well, send them over. They can look through the windows. The buyers looked through the windows of the house, made an offer. We're currently in escrow. And those people are actually in escrow on another property that they saw BC before Corona. They saw it during an open house. Recently, it was withdrawn, but I called the agent. I said, I know you're not on the market anymore, but would you look at an offer? And we put that deal together too. So I'm kind of saying it's business as usual in a very unusual way.
I like
You're doing
that.
it in your business. I'm doing it in my business, but we're definitely getting the job done, right?
How much of that stuff do you think is still going to stay around after? So once we kind of get back to what we want to call the new normal,
Yeah.
I mean, how much of that is still going to be there? I doubt you have clients still peeking through windows to buy houses, but
no,
what is it going to be?
What it's done is really brought the caliber of most agents up when it comes to virtual exposure. So I think BC, a lot of agents maybe weren't doing the virtual, trying to make the property look as best as possible outside of the home. Internet exposure, social media, Facebook, Instagram, all of that has become so important today. I see a lot of that carrying through to when we get back to the new norm, that a lot of agents are going to say, you know what, I owe it to my clients now to do this kind of virtual exposure, because that's what gets people either to the house to see it, or tell their agent, hey, I saw this online. It's interesting. Years ago, when I first got in the business, I would say the overwhelming majority of showings were a result of the agent telling the buyer client, we need to go see A, B, C, D. Today, so that was overwhelming. Like 95% of showings were driven by the agent. Okay. And that was because the client, the buyer client, really didn't have online access to see the virtual exposure of the property. Sure. Today, I would venture to say that 50% of showings are driven by agents. Let's go see A, B, and C. And the other 50% are by the buyer client themselves. I can't remember the last time I've had a buyer client that wasn't proactive looking at property on all the major sites, my site, Zillow, Realtor.com, Berkshire Hathaway's website. So I think that virtual exposure of the property and the way we're doing things virtually, a lot of that is going to stick for sure.
I mean, what should I be telling my pre-approved clients that are out there, they're ready to buy a house, but they're concerned? I mean, everyone's concerned about value. What are you seeing out there with your sellers, with your buyers? I mean, should we be worried about home values?
And that's a great question. And I'll share with you that I spend a lot of my time talking to a lot of agents in a lot of different marketplaces. It's just the ongoing education that I think is important. And I'm sure you do the same thing in your business. What's coming, what do we have to look forward to? We in this marketplace have not seen any regression of price or value. And let's be safe, or let's be realistic and say we're probably somewhere midway through, that curve. They talk about flattening the curve. I think most of the news right now is saying we're kind of at about that point. So now we're on the plateau, soon to be hopefully on the downside, and then moving forward. My gut says if we have not seen a crumbling of prices or an adjustment of prices, nationwide, interesting statistic, only 3% of all listings currently have had a price adjustment in the last 30 days. Nationally, less than 3% have adjusted their prices, which means 97% of the listings that are on the market nationally are saying this is the price of the property, and they're converting. They're putting these transactions into escrow, because if they weren't, we would see a bigger percentage, a larger percentage of price reductions. So as we get more localized in stronger market pockets, like where you and I work most, we're seeing even a stronger commitment to the current price values. And I think when we start to get into the new normal, whatever that looks like, and I don't know if it's 2, 4, 6, 8, 10 weeks away, let's both agree, when they come up with a vaccine for this, right? That will be the true, we're back to normal. And certain industries, I think, are going to take longer to get back to normal, like cruise industry, travel industry, airline industry, restaurants. yours and mine, I think once we get past this, this corona environment that we're in, and we start to get back to President Trump is talking about a gradual, opening up the country. So once this gradual opening up of the country happens, I think you're in my industry, as good as it is now, because it's relatively healthy and sustaining, I think we're going to take a tremendous bounce.
I definitely agree with that. I'm also curious to see what happens with interest rates moving forward, and credit guidelines to kind of get us out of that. I mean, housing leads a lot of recoveries, and I could see the federal government putting a lot of resources towards.
And that was going to be my next question. Do you think we're going to be a protected industry from the standpoint of federal looking at, hey, this is a big part of GDP, right?
Absolutely. It's going to be a huge part. And I mean, I think infrastructure and housing are two big pieces that they cannot turn their backs on.
So from my perspective, if a buyer wants to buy and a seller's thinking of selling, and historically there's only been 4 reasons why people do any of those, buy or sell. And I classify it as up, down, in, or out. Okay. They buy up in size or up in price, down in size, down in price, out of an area, relocation, or into an area, relocation. Closer to the kids, closer to the grandkids, retirement. So up, down, in, or out. I honestly think that's going to be a very strong continuing theme of what we see with buyers and sellers. And I'm assuming that you're going to see strength in your market as well, because we're connected for sure.
Yeah, 100%.
Yeah. Well, Danny, this has been really great. I appreciate you sharing your wisdom and your experience in the industry. If people want to get a hold of you, do you want to toss out some contact information?
Yeah, of course. I'm always here for any questions, finance related. Dan Shea, Prosperity Home Mortgage. Cell phone is 949-382-4401. Always happy to help out.
I appreciate your time. You're a wealth of information. Best lender I know. Thanks for taking care of all my buyer clients. And I'll see you at another escrow.
Stay safe.
Okay, bud. Bye-bye.